There are three, well, we already talked about Social Security FICA taxes, right, which covered Social Security and Medicare. We talked about that last chapter. There are three other main types of taxes. There's property tax, sales tax, and income tax. Okay, property tax is tax based on the value of property you own. Now this is land and permanent structures. So you do not pay property tax on a mobile home or an RV. You don't pay property tax on some Rubbermaid shed that you put in your yard. It has to be a permanent structure on a foundation in order to count towards your property taxes. So houses, garages, some people build like workshops. If it's on a foundation, it gets put into the calculations for property tax. In addition, things like swimming pools, tennis courts, that sort of stuff gets added as well. Sales tax is taxes collected on purchases, and there are multiple levels of sales tax. There's state level sales tax, and then there's county level sales tax, and then there's local level sales tax, so cities. And so if you're paying 8 cents on the dollar, some of that goes to the state, some of that goes to the county, some of that goes to the city. And that's why there will be different sales tax rates in different areas in the same state. And then income taxes are taxes collected on your income that you've earned. And there are three levels of income tax: federal income tax, state income tax, and county income tax. In Florida, we do not have state or county income taxes. We only pay federal taxes. There are only 3 or 4 states that don't have state income tax, and we're one of them. So it's kind of nice that we don't pay income tax. But that is why we have things like toll roads everywhere. So where were we? Oh yeah. Income tax, state, federal, county, and in Florida we do not have state or county. We only have federal income tax. The states that have state income tax don't all have county income taxes. That varies state to state. And it can actually vary county to county inside one state. So inside one state, one county may have income tax and another county may not. And I'll show you where you look for that on your W-2s when we get to that part. Your taxable income is the amount of money that can be taxed, which is determined by deductions. Now, when we pay our FICA, which is our Social Security and Medicare, that is off of our gross income, period. Every penny, every dime, whatever we earned gets taxed for FICA. However, for income tax, not every dollar that you earn is taxed. You can have pre-tax deductions. This comes out of your pay. Things like retirement plans or flexible spending plans for health care come out of your pay before they tax it. And then you can have tax return deductions. And these are, after you've already been taxed, these are the deductions that lower your pay to determine how much tax you actually owe when you file your income taxes. Now, the government agency that collects and monitors taxes is the Internal Revenue Service, or the IRS. Their website is www.irs.gov. I recommend that you do check out that website at some time. They have every possible tax form that you could ever want to look at on there, able to be looked at as PDF, and as well as all the instructions for all the tax forms are on there. In addition, though, they have resources. There are links for free sites to file your taxes electronically. There are links to get tax assistance if you are self-employed or own your own business. A lot of stuff on there that's really good. Okay, your filing status, wow, that doesn't say living. Your filing status is based on your living situation, and it determines your tax rate. We have single, married filing jointly or qualifying widower, married filing separately, or head of household. These are the statuses. Single is that you're unmarried. Married filing jointly or qualifying widower or widow is that you are filing your taxes together on one form, and you are married or you became widowed or widowered. I don't know if that's how you'd say that. But anyway, your spouse died within the last year. You have 1 year, like one fiscal year. After that, you become single. So they had to have been alive during the year you're filing taxes for you to file married filing jointly. Married filing separately is when you're married, but you're filing 2 separate income tax forms and splitting the income. So the husband is claiming his income on his tax form, and the wife is claiming her income on her tax form separately. This is at a higher tax rate than filing together. Okay, but there are reasons you may want to file separately. These can include deductions or child support or alimony, things like that from like prior marriages. There can be very good reasons to file separately. And then you have head of household, which is like single, but it's a special filing status. You're not married, but you have dependents. And your dependents have to be related to you, primary family, or you have to have legal guardianship. You can also, I just recently found out, claim your fiance if they are unemployed. Now, you cannot claim as dependents. Pets are not dependents. Even though they depend on you, they cannot be claimed for taxes. Livestock cannot be claimed for dependents. That actually happened. Somebody got audited and got in a lot of trouble because they were claiming their horse as a dependent for years and years and years. Your roommates, even if you have the most deadbeat roommate in the world and you pay for everything, they are not your dependent. Okay? Your best friend, not your dependent. Just boyfriend, girlfriend, not dependent, has to be fiance. Your kids, if you have a parent that you take care of, a sibling that you take care of, you can claim them as dependent. And if you have legal guardianship of any children, so your third cousin, second, twice removed kid you take care of and you have legal guardianship, that would be okay too. Foster children, anything like that. Stepchildren, but then you wouldn't have them under head of household because you'd be married. So head of household is unmarried with dependents. And if you have a question about whether or not you can claim somebody as a dependent, the IRS on their website has this little quiz thing that you go through and you answer questions, clicking, click yes, click no, things like that. And at the end, they tell you if that person is a dependent or not. So that's kind of nice. All right, so this is an example of what the tax paperwork looks like. Now, if this is, again, we're using the 2012 tax table, and on the 2012 1040, line 43 was your taxable income. Okay. So, when you read the tax table, it's at least but less than. That means that between 0 and $4.99 would be this row. And then you go 5 to $14.99. It doesn't actually include this 5 here. The 5 is included here, but not here. So when you read this, this would read as 0 to $4.99. And this would read as 5 to $14.99. 15 to $24.99, Does that make sense? Because that's but less than this number. So it can only be up to 99 cents before it. And then you have the status: single, married filing jointly, married filing separately, or head of household. So hypothetically, if I made $51,482, I'll go to the column on the page that has the 51,000s. So in your packet, that is on page 85. Okay. And then you look in your 51,000s. Now this picture here is not the same as the 2012 tax form that I've given you, okay? So we're not going to get the exact same numbers. But when you look at it, it's 51,482, which comes between 51,450 and 51,500. So we are going to be in this row. And Ron is single, and since Ron is single, we are going to be in this column. So we take the figure where our row and our column match, which is 9,213. That's how much Ron would owe in taxes. So that's how you read the tax table. The way they calculate taxes is based off of a schedule. So if you flip to the back of your tax table packet, you'll see the tax rate schedules. This is how the taxes were determined. Now this page here on the tax table is for informational purposes. You don't actually have to use this for real calculations, but I'm going to teach you how the calculations are done so that you can test them. So Schedule X is if you're single. Schedule Y1 is married filing jointly. Y2 is married filing separately. And Z is head of household. And what they do is they take the income, and you'd be between this line. Let's say you were talking about, let's say $70,000. You would be between $35,350 and $85,650. You would take $4,867.50 plus 25% of the $70,000 minus this. So we're going to go over that really quickly with this example. They're making $153,900. That falls in between $131,450 and $200,300. That's a zero. Sorry, the print is not so good. Okay, so the 153 falls between these two numbers. So this is the calculations that we have to use. 25,550 plus 28%, don't forget to always convert your percents to a decimal, of the amount over, here actually I'm going to move that down a little bit. The amount over this. So I'm going to take their income and subtract that amount that's listed right there. So basically the setup for this is this dollar amount plus percent times income minus that number. So for this, Maria and Dawn, for their taxes, I have to take $25,550 and add that to 28% of, let me do this subtraction really quickly. %of 22,450. So first I take the percent, then they add. So their tax bill would be $31,836. Now, if we were using the same, if our tax table, our paper tax table matched this tax table same year, then this amount would match what we get in the columns on the tax table. Since we don't have the same tax table as in this example, we can't compare them. But if we were able to compare them, they would match. If you look at the next to the last page of your tax table, you get the tax computation worksheet. So this is, we were just there, it's the next to the last page. Now this particular worksheet is what actually gets used to calculate taxes. However, only for certain people. The tax table only goes up to $99,999 and 99 cents. So if anybody made more than that, so 100,000 or more, the tax table doesn't have what they owe in taxes on it. They have to use this sheet, which is basically the same as this, but presented in a way that will make more sense for people to follow. Because you just fill in the box and follow the directions across the line, as opposed to having to do what we just did. So if we look at that, here's an example. For taxable incomes over $100,000. So we're going to use the same income, the $153,900. And if they were actually filing their taxes, they would not use what we just used. They will use this computation worksheet. They're here again between the $131,450 and the $200,200. So we enter their income on this first box. And it says to multiply by 28%, and it tells you right here in the parentheses 0.28. So we're going to take this number and we're going to multiply it by 0.28. And we will get 43092. And then it says subtraction amount. So you subtract this amount from that. So minus 11256. And I get 31,836, which is exactly what we got before. Yeah. So this is the actual table that is the actual formulary for how the taxes are calculated for the whole tax table. And again, this is only on the tax table for informational purposes, but we're going to learn how to calculate this so we have more practice with calculations of this nature. This is on the computation worksheet. So for anybody making over $100,000, this is the part that they actually fill in and actually do. Your gross pay is what you earned. So this is your salary or your hourly wage before any deductions. So before taxes, before insurance, before disability, retirement, flex accounts, before any of that. Your net pay is the actual money that you get to take home. Your take-home pay is also what it's called. And this is after all of the deductions. So after taxes, after retirement, after anything that comes out of your check. Now your pay stub, you are required by law, well, not you are, the employer is required by law to provide you with a pay stub with every check. Now this can be paper or electronic. A lot of times if you have direct deposited checks, they won't give you a paper pay stub. You can access it electronically. It has to show your gross pay for the pay period, all of your deductions and taxes. So anything that was deducted from your check for any reason has to show up on the pay stub, as well as all of your taxes. And that's income tax, Social Security tax, and Medicare. All have to be listed. And your net pay after all of the deductions. And it not only has to list this for each individual pay period, it has to list the year to date as well. So starting January 1st up until December 31st, it has to keep a running total legally. And this is for you to be able to check and make sure that everything is accurate, that the deductions, you know, your gross pay minus the deductions actually equals the net pay that you took home, that, you know, your hourly, if you were hourly wage, that you actually received the pay for the hours that you worked and things like that. And also for you to check your taxes and make sure that those have been taken care of. You should keep your pay stubs for at least a year, because if for some reason you don't receive a W-2 for tax filing, you can use your pay stubs for tax filing if you have all of them from January 1st on through December 31st. So you should hold on to those for at least like the 1 year period. When you get hired, you fill out the W-4, and in case anybody didn't know, that stands for Employee Withholding Allowance Form. And this is the form where you indicate the level of your tax status numerically. Basically, you claim how many deductions you want to claim. You get to claim one for yourself, one if you're head of household, and then one for every dependent. And then there's some other things. My advice to you is when you fill out that little worksheet on the W-4, never claim as many as it says you can. 9 times out of 10, if you claim as many as it says you can, you will owe taxes at the end of the year. Always claim less than it says you can. If you're single, the best thing to do is claim 0. They may take more money out of your check initially, but you get it back. Withholding allowances for withholding taxes, it's your income tax. When your taxes are taken out of your check, they are prepaid. Your tax bill is not actually due until April 15th of the following year. So for 2015, our taxes for this year will be due next April 2016. But what happens is your employer takes money out of your check all year long, and it gets held basically as a prepaid tax. This prepayment of taxes is based on the numbers that you put on the W-4. So how much they take out of your check it depends on that. And it's an estimation. It is not 100% accurate, because your pay can change throughout the year, and they're basing it off of an annual projection. So a lot of people get money back every year. A lot of people pay extra money every year. It just depends. The W-2 is what you get. It's the annual form that reports your income and all of the taxes withheld and any tax-free deductions, things like that. And this is for your tax reporting purposes. The deadline for mailing this is January 31st. So January 31st, 2016, every company legally has been required that they must have their W-2s mailed out for the 2015 year. Same thing for the 1099s, which is similar to a W-2, but a 1099 is for non-employees. So this is non-employee income. If you're an independent contractor, if you received royalties on something like book sales or something like that, some bank interest comes on a 1099. Any other non-taxed, non-employee income gets reported on a 1099, which we'll go over those too. Any questions? Everybody got it? Okay. So, Barbara started a new job and she wants to verify her net pay. Okay, her gross pay was $2,269.75. Okay, Okay, she has FICA tax of 6.2%, so we need to calculate FICA. So 0.062 times 269.75. So that's going to be 1672. That was FICA. Okay, and then she got Medicare of 1.45%. So Medicare, we need to calculate that. So that's $391. Okay, so we got gross pay, we've got our FICA, we've got the Medicare. Federal withholding tax, that's federal income tax. So I'll just put FIT for federal income tax of $47.51. Okay, we got that. State withholding tax, so that's state income tax of $16.62. That's there. Retirement insurance of $9. Disability of $256. And medical insurance is $12. And dental is $6. And that will give us her net. We have to subtract all of those. So her net pay should be $155.43. Any questions about how to calculate that? This is a example of a pay stub, and they all look different. It just depends on the company you work for. There's no rule that says pay stubs have to look a certain way. So what you have is, this is her pay period, so 2 weeks. This is the current amounts, and this is for all year so far. Okay, so if we assume that her salary and deductions remain the same throughout the year, how much will be taken out for federal and state taxes? Okay, so this is bi-weekly, which means she gets 26 checks in a year, right? Remember that from last chapter? So federal and state. And that's right here on the pay stub. And you can see she has her earnings. Then she has Social Security, medical care, Medicare, federal tax, state tax, unions, insurance, and retirement are all being deducted. Okay, so for her federal tax, $26,038.22. And for her state tax, $7,303.14. Now, in a state where you do pay state income tax is a federal tax deduction. So she would be able to deduct this out of her federal taxes, which we'll go over when we talk about the long form, the 1040. Like I said, I'm not going to have you actually fill those out, but we are going to go over them so that you know what they look like and you're familiar with it. And these are, the IRS puts out a template for these, and so everybody's W-2s pretty much look the same. You will have on your W-2 your social security number and your employer ID number. This is their tax number for the company. Then you have your wages, tips and other compensation, Social Security wages. Actually, there should be Medicare wages on here too. I don't know why that's not on there. And then, hold on. Okay. You'll have your Social Security wages, your Social Security tax withheld, your Medicare wages, and your Medicare tax withheld. Those will all be on there. If you worked in a tipping industry, these may be filled out or may not. They could put your reported tips up here, just depends. Advanced EIC payment, this is earned income credit payment. This is something that you would set up on your W-4 if you wanted extra money taken out of your check. It would get reported here. Dependent care benefits, if you receive dependent care benefits from your employer, that would be here. Non-qualified plans, and then we also have retirement plan. I can't read that. If you've had deductions for a prepaid, like a flexible spending account for health care or for child care, those get here under other, and then you have some other things that show up here. They're not, this area is not terribly common unless you have retirement account, a flexible spending account, or some unusual employment. Then on the bottom row is the state and local taxes, income taxes. So if you have state income tax or local income tax, again, this is county level, which we don't have in Florida. So all of your W-2s, this part at the bottom should always be blank, unless you're working out of state. Okay, so how much did she pay in taxes during the year? So this is federal taxes. This is Social Security tax. And this is Medicare tax. This question is kind of ambiguous. If it said how much did she pay in income taxes during the year, it would just be this federal. Okay. But since it's pretty ambiguous and it just says how much does she pay in taxes, we're going to add all three together because those are all three types of taxes. Oh, we also have state and local. So we're going to add 5 together. Altogether, income taxes from federal, state, and local, as well as Social Security and Medicare, is $28,128.28. We have another W-2. Do you see this? Her wages, tips, and other is $78,900, but then her Social Security wages are $92,100. Now remember, I had said that your income tax is not taxed on all of your income necessarily. There are some pre-tax deductions. So pre-tax deductions lower income tax, but not Social Security or Medicare. Okay, so that accounts for the difference between the $78,900 and the $92,100, and you'll see that right here And right here we have some extra numbers. This E indicates it's a retirement account. Okay, so 12,200 went to retirement. Okay, certain retirement accounts, if they come out of your paycheck directly, they are not taxed until later when you take the money out. When you actually retire, then you pay taxes on it then. But when they take it out of your check right now, you don't pay any taxes on it. And then this right here is a prepaid health plan. Okay, so $1,000 went to a flexible spending account. This money comes out before you get taxed for income tax, and it can only be used on certain expenses that have been approved by the government. So, child care, parent care if you have an elderly parent that needs care, prescription medications, doctor's visits that are medically necessary, so you cannot spend it on anything that's cosmetic. Same thing with prescriptions, you can't spend it on cosmetic prescriptions. You can spend it on dentist, but again, not cosmetic dentistry, only medically necessary dentistry. So fillings, root canals, braces would be allowed. And then certain over-the-counter medical things, and there's like a whole list of what qualifies and what doesn't. So like contact lens solution does qualify, but Visine doesn't. And Band-Aids do, and some sunscreens do, and some don't. And there's this whole list you can find online. But these things, you get to have the money tax-free because medical expenses are a tax deduction if you're itemizing, but not very many people have enough expenses to itemize. So this is like something that the government has done so that to make it fair for people that can't deduct that, because even if you do itemize, this $1,000 that went to a flexible spending account couldn't be added into that again. So you can't get the tax break twice on the same money. Does that make sense? At all? Okay, a 1099 again is for non-employee income. Okay, so you may kind of technically work for a company, but you work as an independent contractor. You're not considered an employee, and companies choose to do that because if you're not an employee, their expenses for you are less, and they don't have to deal with your taxes. You have to deal with your taxes. Okay. That's weird. So this is what a 1099 looks like. Now, sometimes they will take tax out on a 1099, but very few people do. It is possible though, and if they did, that would go right here. But 1099s mostly don't have hardly anything at all filled out except this just one box. And so if we look at one that we can actually, all right, so there's different types of income. Rent. So if you, say for example, you own property and you're collecting rent through a property management company, the property management company might send you this 1099 form so you can claim all your income from your rent that you've been collecting. Royalties, that's if you published a book or you've been in a commercial or a movie or something and you earn royalties. Other income can be anything. Fishing boat proceeds, Deadliest Catch, you know those guys? This gets filled out for them. That's for people that work on the fishing boat and then they get paid. but they don't get the boat owners don't pay their taxes for them. They have to pay their own. Non-employee compensation, this is if you're an independent contractor. Most people that get a 1099 have this box filled out. I'd say the majority. Substitute payments in lieu of dividends or interest, that would come from a bank. Payer made direct sales of more 5,000 or more of consumer products to a buyer. That that's if you own your own business kind of a thing. Crop insurance, only if you're a farmer. Golden parachute payments, not really sure. It's got something to do with retirement, etc. And then you have the payer's name. So this is the company or the individual that paid you. And then their ID number, and then your ID number, which is your social security, and then all your information. And again, there could be taxes withheld reported on a 1099, but it's rare. Usually a 1099, there haven't been any taxes taken out of that money at all. Okay, so that's the 1099 form. And we are going to stop there today. So your homework is the Chapter 7 packet.